Hello and welcome back to my channel. In today's tutorial, I'm going to be sharing with you a very simple strategy which you can use to trade the Forex market. You can use it to trade Bitcoin, and you can as well use it to trade stock or indices, depending on what you like to trade in the market. But this strategy is something very useful and it's very easy to master. All you need is to keep the rules and follow the strategy judiciously, and you will really appreciate how simple the strategy is. Without wasting much time, let's dive into it. So we'll be using two indicators, mainly for day traders, but we're going to add a third indicator which will be utilized by scalpers. As you know, there are some people who like to scalp the market just to take 10, 15 pips at every movement of the market. Those who prefer to trade like that, I have something here for you on this video. So without wasting much time, let's dive into it. First indicator which we are going to be using is Ichimoku indicator. As you know, Ichimoku is a bit of complex indicator, but we are going to make it very simple by utilizing just two components of Ichimoku. As you can see, I've disabled the Tenkan-sen, the Kijun-sen, and the Chikou span. So we'll be utilizing the Kumos, the Kumo up and the Kumo down. So we add this to the markets. Why do we use this Ichimoku indicator? This indicator helps us to picture the markets, to be able to know that whether we're in the uptrend or we're in the downtrend. As day trader, I usually want to trade the hourly time frame. So with this indicator, I have a clear picture, not going against the trend, but moving with the trend, because I'm a trend trader. So I like to trade the market going with the trend. So the next indicator which I would like to add is a moving average indicator. I'll be using 50 exponential moving average. I set the color to blue. It doesn't matter, you can set it to any color you like. It depends on your preference. So now, as you can see on the chart, our rules are very simple for this strategy. What we are looking at is to have a defined trend. What do I mean by defined trend? Defined trend is when you know, looking at the market completely, that you will be able to understand that this is an uptrend based on the indicator which we are using. So let's take, for example, we are at this point in the market, and this is our EMA, which is guiding us to know if price is above, and we are looking at the point when the price is above the Ichimoku, and also the price is above the 50 EMA moving average. So what we capitalize is, as the price is at this point, the moment we see that the price has entered the cloud, okay, we are watching to see whether the price will still continue in the downtrend, because at this whole area we consider the price to be in a downtrend. So here all we'll be looking at is opportunity to sell the market. But as we come to this point, you can see that the price has broke above the Ichimoku cloud. And once the price is above Ichimoku cloud, we are looking at the bounce on the 50 exponential moving average. So we wait to have a defined trend. These were the candles that form the break of the Ichimoku. So we place our horizontal line to be able to know when the this particular level is broken. So you can see from here this price broke above the trend line and close above the high of the candles which form the break of this cloud. So this is the defined trend. So at this point we define that the trend has now moved from downtrend to uptrend. It is clear now to us that we are now in an uptrend. So what we are looking at is for price to break the moving average and close above the moving average. So at every particular point, once the price break below the moving average and close above it, we open our buy trade. So you see at this point price break below the moving average, still in the uptrend, and close above the moving average. Here again we enter a buy trade. So you see we continue and we use the Ichimoku also to trail our profit. So as the price is moving, we are moving our profit. So you see here point when we enter the market, for example, this was a break. When we enter the market at the close of this candle, our stop loss is below this point. So this is our stop loss. Here also, when the price at this point break and close above the moving average, we enter the market at this point and our stop loss is at this point. So this is how we utilize this strategy. At this point, you can see when we got to this point, at this particular point, this did not meet our criteria. Understand that our criteria is that price will break below and close above. So the candle will break below and close above. Here, the candle break below but remain below the moving average. Here, the candle open below and close above. Here, the candle open above and close below. So you can see, once you start getting conflicting up and down, at this particular point, let me try to highlight it. So you can see the whole of this area is consolidation. And once you have consolidation in the market, is either that news is very close at this point during the trading hour, or something is not, because you can see at this point there is no reasonable trend. So once you are getting experience in the market, you will know that this is not a good area to trade. So here you can see, here we have a break below this candle break, and this one tried to penetrate the cloud but could not, and go back again and close below. So what do? We put our horizontal line to wait for confirmation of downtrend, and as you can see, there is no confirmation. The price did not break the horizontal line to confirm our downtrend. Instead, the price went up and continued. So this strategy will help you to avoid a lot of whipsaws in the market, which is classified as false breakouts. So with this strategy, you can avoid a lot of false breakouts. So here, we can see clearly that this did not meet our criteria. So we see the price break above this candle first, and this is the second candle which break above the cloud. So what do? we take our horizontal line and we mark this candle. Then we wait for confirmation, and you can see the series of candles that comes after, they all close above our horizontal line. So here we are waiting for our trigger, and this is the point where we got the trigger. So sometimes you might miss some good movement in the market, but you have to stick to your rule, because you don't jump into the trade because as you are seeing it. So you need to follow the plan, the trading plan, and stick to it. So here we have likely opportunity to enter the market, and we'll continue like this. All we are waiting for is for price to come, break this moving average, still stayed at the uptrend, and close above it. The moment we have this, we enter the market without looking back. If you like to scalp the market, let me delete most of these lines in order to clean up the chart. Okay, I remove these ones. Okay, so now we have our chart clean again. So for scalpers, I'll be adding parabolic SAR. Trading with parabolic SAR is very straightforward, but just to explain for those who don't have much idea about this indicator, the parabolic SAR is a simple strategy indicator which you can use as a scalper just to target 10-15 pips depending on the time frame which you are using. Let's assume one is trading the daily market. You can see there are much opportunity to capture, but if you are as a day trader using a 1 hour, you capitalize on this as a scalper, because this will not really go well if you are going to do it as a day trader. So use it for scalping, just to gauge the market and enter. So how do we enter the market using this? So if you can see, the first thing you do is to make sure that you have the first rule. Rule number 1 is to ensure that you identify the trend. So how do I identify the trend? Again, as explained before, you make sure that there is a break above the Ichimoku cloud. Once there is a break above this Ichimoku cloud, you target which candle form the break. As you can see, these were the candles that form the break. So you place your horizontal line and wait for the subsequent candles to close above the horizontal line. Once you have the candles above the horizontal line, then you start waiting for opportunities for an uptrend in the parabolic SAR. So here, as you can see, at this point, you have a break up, so you enter the market. Your target is to get maximum 20 pips, maximum 20 pips. Here you have 28, so all you are looking for is opportunity to get maximum 20 pips. Here again, you have another signal. As you can see, at this time, this signal happened here, and here you get up to 50 pips. But your target as a scalper should be 20 pips. And how do you secure yourself in order for protection? Make sure that your stop loss is below the parabolic SAR. So once you enter the market here, okay, your stop loss should be here, and you target 20 pips. And you move your stop loss as the parabolic SAR is moving, you are trailing your stop. Don't waste much time, because parabolic SAR does not give good signals most of the time. But with this as a scalper, you can utilize it and you'll be able to trade the market. So you can see at this point again you have a signal, and your target is 20 pips, and this went as far as getting up to 100 pips, but your target should remain 20 pips, and your stop loss should be at the level of the parabolic SAR, and you trail your stop. Much of experience, and you see that the market is really going your way, you can keep trailing it, but as a scalper, stick to your 20 pips. Once you get your 20 pips, move your stop loss to that point so that you protect yourself. This is how you continue with the strategy. At this point, again, here you have a signal, and you see on this signal you got up to 32 pips, and here again you have a signal, and this signal you got up to 50 pips. So this is how, and see at this point, like I explained before, you have here consolidation. You can see the parabolic SAR is coming down, and here is giving you a signal, but the price is within the moving average, so which is not a valid signal, because as per the rule number 1 is that the price has to be above the moving average, and the price has to be above the cloud. So if the price is not above the cloud and not above the moving average, then there is no valid signal. So the same at this point, you have a signal, but this is not a valid signal because the price is below. So here you can see at this point, this is where you have a valid signal which satisfies the rules. The price is above the moving average and above the cloud. So here you target your 20 pips, but you see this gets up to 50 something pips. Okay, same at this point. Here you have a valid signal, but this time you move the price come down, and we are stopped out at almost break even. So here again you have a valid signal, and you enter the market, and as you can see you make up to 50 something pips, but your target remains 20 pips. Here we enter, but we're stopped out. Here again we enter. As you can see, this is a live market. Here again you enter the market using the same strategy, and you're able to make your 20 pips, but the price move as far as 80 something pips. So this is a very simple strategy for scalper which you can utilize, but you have to keep tab with the market. As you know, scalping is a bit tricky, and you have to practice to get used to how you target the market and how you make profit from the market. Watching, and I will please appreciate if you can subscribe to our YouTube channel to encourage us to make more videos like this. Like and subscribe, and see you next time.